Welcome to the Matching Ideas with Resources Networking podcast sponsored by GLM Financial, an accounting firm in Schaumburg focusing on providing professional accounting and business services to small and medium-sized companies throughout the Chicagoland area. I'm Tom Ghosh, business strategist with GLM. Today I'm talking with Tom Stamborski from Liquid Capital. Tom helps business owners with alternative financing like purchase order financing, factoring, work-in-progress lending, asset-based lending, and a new product that lends for working capital. We'll talk about how these products can help you with special projects financing that you might not be able to get from your bank. Tell me just how you got into the factoring business.
Well, by way of background, I started in the financial services industry in 1976, so this year will be 40 years in financial services.
Wow.
In a variety of capacities, a lot to do with wealth management, asset management, financial planning. For 13 years, I worked exclusively with regional community banks, setting up brokerage operations to provide those non-bank products to their customers. In 2005, I left my last corporate position looking for something a bit more entrepreneurial because previously I had owned my own businesses in the financial services industry. And then really I kind of discovered this alternative financing factoring industry in '05, and then ultimately got involved with Liquid Capital in '06. So it'll be 10 years actually this month.
Oh, wow.
That I've been with Liquid Capital.
Happy anniversary.
Well, thank you very much. So it's been an interesting 10 years. I enjoy the industry quite a bit. We have a variety of products that we offer, which we can certainly chat about if you'd like. But I think what really is very gratifying to me is the effect that we've had on these business owners through a period that would be considered rather trying.
Sure.
Certainly, I didn't know in 2006 what was happening in the next year or two, and the impact it was going to have on these companies. So really, maybe it was a perfect storm as far as timing is concerned. But there has been since then certainly anywhere from an evident to dramatic need for some types of financing which would augment bank financing, or for a newer company give them a bridge to traditional lending. And I've written about this in some of my newsletters, that at the end of the day, it gets well beyond financing. It really talks about companies staying in business or seizing business opportunities, being able to retain employees, being able to add employees, acquire equipment, expand their facilities. So it's really run the gamut as far as the client situations over the last 10 years. And the situation economically right now for these small and medium-sized businesses, I would say, is getting somewhat better, but not dramatically better.
Right.
I think there's still a lot of challenges to be able to get the kind of financing that they need. Ultimately, my goal is to get them into traditional financing. So in many instances, we're a bridge to that, or maybe working alongside of the bank, but the bank could do more for them, at least on an interim basis. So it's been a wide spectrum of client scenarios. Again, the guy who has 10 union workers and they can't make payroll this week, to the company that's got a huge business opportunity and they don't have the overall funding to be able to capitalize on it.
So describe what factoring is specifically.
Well, factoring, let me contrast that to maybe traditional lending.
Okay.
If you were to go into a bank and try to get some type of financing, whether it be a line of credit or a term loan perhaps, they're going to go through their analysis to see what you might be eligible for on the basis of typically a cash flow model, which is typically more historic analysis versus prospective. And to the extent that they're able to give you an accommodation, they're going to look at what kind of collateral that you have to offer, which could be your accounts receivable, it could be inventory, it could be equipment, it could be real estate, combination of all. And based on that collateral, they would give you a percentage of the value of that collateral and then create a line of credit reflective of that collateral. They would continue to monitor your business activities to see if you're able to stay within that cash flow model, monitoring the quality of that collateral just to make sure they're secure. And you would in essence create debt, if you will, by virtue of that type of financing structure. Now, factoring, in contrast to a bank who is lending, factoring is the ability to assign or sell your accounts receivable and be able to leverage that asset, if you will, to be able to get cash flow on a more immediate basis. So factoring, we're buyers, if you will, of accounts receivable. A bank would be a lender against your accounts receivable. In a factoring transaction, we create no debt.
Right.
We leverage that asset, and really for the client, the benefit is that even in today's economy, you look at, let's say, what are the terms of your invoice, and you would like to believe you could do net 30 days to get paid. But I would say in great part over the years, we've seen that time become stretched out to where now it's 45 days, 60 days. Sometimes if you're dealing with a large retail customer like a Costco or something like that, it's 75 days. Sometimes I've seen as high as 120 days. And the net effect on the business owner is they're waiting to get paid. They don't want to lose the customer, but they have current operating expenses that they have to put in abeyance or have to guess at from a strategy point of view as to what they pay now, what can they do now until they get paid by their customer.
Right.
Whereas in a factoring transaction, once we approve the customer and we buy that invoice, we provide immediate cash flow to the business owner. And then we, as the owners now of those receivables, wait to get paid by their customer. So we take all that second guessing out and give them predictable cash flow versus kind of guessing at when they're going to get paid. And I think it just stands to reason that a business owner, knowing when their cash flow is coming in, can make logical current business decisions versus deferring those, not knowing when they're going to get paid.
Right.
So it's, again, factoring, is really the assignment and sale of creditworthy customer invoices versus pledging them as collateral to a bank for some kind of loan or line of credit. So that's kind of the differentiation there.
Very cool. Very cool. So, what types of businesses generally can more take advantage of something like this? What's the situation that a business is in that could probably use your expertise?
Well, in the area of factoring, it really kind of runs the gamut. I mean, it's a fairly large spectrum of businesses that could use our services. I mean, realistically, our basic criteria to open the conversation is they're a business-to-business company. They've got creditworthy customers that we can approve, and they're knowledgeable of their industry. So those three criteria is the basis for making the initial conversation. Clearly, the underlying issue is I've got these customers, I want to retain them, but they're not paying me on a timely basis. I don't have predictable near-term cash flow. So that's the general issue for all of these companies. And this really covers pretty much all industries, because I've dealt with manufacturing, distribution, service, technology, consulting, staffing, trucking. They all have issues relating to cash flow. If it's a new company, let's say we have knowledgeable managers, but it's a new company, generally speaking, it's going to be maybe 2 years of operating history to go to a bank and get any kind of reasonable accommodation.
Right.
Clearly, those first 2 years are the most critical period in the life cycle of any business, and that's when they really need a leg up, if you will. So in many instances, they may work with us where they have customers they're taking in business. Bank can't currently give them an accommodation. So we'll work with them until such time as they have financials and operating history that are attractive to a bank, and then either they can locate a bank or we can introduce them to a bank and start a transition process to get them into the bank, where we ultimately extract ourselves, generally speaking, as kind of that stepping stone for a new company. The other side is we have a company that has a banking relationship, but by virtue of that cash flow model, the bank says, we can't provide any more financing beyond what we've done so far. The majority of bankers do not want to say no to that client.
Right.
They want to do whatever they can reasonably do to keep them as a client. So in many instances, I get called in by bankers to augment their financing on a shorter or longer term basis to be able to retain the client, give them what they need, but still stay within the underwriting requirements of the bank. So to answer your question, it's a very broad spectrum of industry types and scenarios that could dictate the need for our services, but underlying all of that is I need to have near-term predictable cash flow so I can make smart business decisions today versus sitting there and second-guessing what I can do.
You had mentioned in the beginning about a business owner that might have an opportunity where he doesn't have the cash right now, but he's got a big order. And is that a purchase order financing, or is that still accounts? Is that still factoring?
Generally, it's a two-part strategy that encompasses both purchase order financing and factoring. Classic example, let's say we have a distributor, and maybe their average order is $20,000. And through good fortune, luck, whatever the case, kismet, they come across an order for $200,000.
Yeah.
That's the good news. The good news is this is a very, very large order, out of the ordinary. Typically, it's kind of a watershed event relative to the growth of their company, and they'd like to seize that opportunity, but in many instances, they go back to their bank, and they say, well, that line of credit that you've given me for $50,000, I need to triple that to $150,000. In many instances, the cash flow analysis says we can't grow that fast. In many instances, the supplier or the manufacturer that's going to produce the goods is overseas, and the bank may not be particularly inclined to do foreign purchase order or supplier payments, or having inventory on the water being delivered from, let's say, China or another country. So in many instances, the bank says, I can't do any more for you. And it's an ironic situation where it's a high-growth, opportunistic type of scenario that is crucial to the growth of that company, and the bank can't help them.
Right.
So in purchase order financing, what we can do is provide payment to the supplier up to 100% of the cost of the goods, whether they be a domestic or foreign supplier, be able to take the order, and in a traditional purchase order transaction, the product is produced and shipped directly to the customer. My client really doesn't do anything to the product whatsoever. It goes right to the customer. So now we've been able to seize the opportunity to pay the supplier. We've now delivered it to the customer. Now we have a customer who has delivered. We have delivery and acceptance. They've received the goods that they have paid for or will pay for, and now we have the opportunity to create an approved invoice. So what happens with the purchase order financing? We have a certain cost for paying the supplier. We typically have some fees attached to that. Depending upon the situation, we may have credit insurance as well. So now we have to pay that supplier, or pay the purchase order finance component of this transaction. What happens is, now we're on the customer side, and we've created an invoice. Again, could be net 30, could be net 50, whatever the case may be. So what we do is we would also factor the invoice to the customer and have immediate cash flow available. The first dollars that come off the purchase of that invoice go to pay off the purchase order supply side. So we pay a supplier, let's say $50,000. We're going to charge our customer $100,000. So when we factor that invoice for $100,000, the first $50,000 plus fees and so forth will go back to satisfy the debt on the purchase order side. The customer is now left, or my client is now left with the balance less our fees for factoring. So we accomplish two things. We're able to take the order. If we do 100% financing, the client pays little or nothing out of their pocket. And instead of waiting 45, 50, 60 days to wait on the factoring side or on the invoice side, they have immediate cash flow. We've paid off the purchase order side, and now they're left with their margin on that sale, less our fees. So it's a two-part strategy that works in combination. So typically, if you're doing purchase order financing, you're going to have to use factoring. The only other way that you could do that transaction without the factoring component is have the customer post a letter of credit. Some will, some won't. But those are typically the two ways that you can do a purchase order transaction.
Interesting.
But that, generally speaking, PO purchase order transactions are very opportunistic. They typically are a big deal to the company, and it's typically sometimes a major stepping stone in the growth of that company.
Yeah.
And that's where the ironic part of the situation comes in, to where it's a huge deal, and I may have to walk away from it.
Right.
And I can give you many, many examples of how we've really allowed clients to be able to really get up to another echelon of customer type by virtue of the bank showing capacity.
Sure.
Because when you get a purchase order, typically it's time sensitive and you have to have delivered within certain dates. And it may be, let's say your first order from Costco. You need to deliver on time with products that meet their quality standards, otherwise you probably won't get a second chance to get that second order. So not only is it a big opportunity just from a dollar point of view, but it's also giving you the ability to maybe cement a relationship that could last for years, which could be even greater opportunities down the road. So it's an interesting situation.
It is interesting, and it's interesting that the current relationship with the bank. The banker is probably telling them, hey, you gotta, keep getting out there, get more revenue, and do all this stuff. They finally get that opportunity, and the bank can't help them. But as you were saying, one of your goals is to get them to be able to go back to the bank, and with the revenue and the financial statements that they're going to have and the history they're going to have, all of a sudden they are going to be able to get that line of credit increased from the bank. And then they're just another echelon of company. So it's really good.
And because this type of transaction is transactional. It sounds redundant, but it could be a one-time event. It could be very specific to seasonal issues or certain customers. So there's no requirement to do this on an ongoing basis. It could be very, very strategic. And that's the way that we like to work with our clients, is to deal with very, very specific strategic initiatives and not have them tied to some long-term commitment to do transactions that may not be necessary. Right.
And actually, there was one of the clients that I was working with, I noticed that they had a really good 2015 compared to 14, and in kind of just learning more about it, they had an opportunity with a company, and it was a one-time order. And what he ended up doing was loaning himself, the personal loan of himself to the business, just to cover that time period.
Right.
And again, it shows the debt, it shows his debt and everything for that few months. The business ended up paying him back, which was wonderful. But the financial statements reflect that there was a debt, and having a factoring issue would have been a lot better, in the long run for him.
Well, clearly I see that when I look at the financial statements of companies that may be interested in doing business with us, I see very often shareholder loans just like that, second mortgages on homes, high credit card debt, very highly leveraged, and certainly putting additional strain on the financials, and especially the financials of the owners. Whereas using our services strategically, we can alleviate them from going through that process. We're not creating any debt, and I think in great part working with these clients, it's not only the financial component, it's the emotional component. Because in the absence of having the kind of financing that you need, typically you spend a lot of time and effort trying to find an answer, and in many instances you take your eye off the ball in the operations of the company, which only exacerbates the problem that you're dealing with. So we also try to give them the ability to have that type of financing so they can concentrate on the business and not so much just running around and incurring a lot of personal debt to try to stay alive or seize opportunities. So that's a big part of it.
Yeah, that's huge. That's big. Interesting.
Well, I'd like to talk a little bit about some of the other programs that we have, because we've got different strategies for different scenarios. Kind of taking up on that purchase order transaction, one of the areas that has been challenging for a lot of companies, especially in working with their banks, is where there's what's called a work in process component to the delivery of the product. So in this particular instance, let's say again we have a purchase order from a customer, and we still have to pay a supplier, but instead of delivering the product directly to the customer, the product or components will be delivered to my client, and then my client does something to it. Value add, assembly, manufacturing, repackaging, all of those, and then they ultimately deliver it to the customer. So that's called work in process. Banks generally are not favorable to work in process because there's a lot of unknowns, if you will. So they probably will give you very little availability within your line of credit based on that portion of your business. But work in process for those companies typically is part of their day-to-day business. And it's very, very difficult to finance this type of transaction for many, many years. We have a program called the Purchase Finance Program, which is designed specifically for that scenario. It requires that when we do our due diligence on the client, or our potential client, they don't have to be perfect on their financials, but they have to be a viable, ongoing entity that could survive without our help, but would do better with our help.
Got it. Okay.
So the financial ratios have to be a little bit stronger. Secondly, because of the structure of this program and our underwriting, we also have to make sure that our client is eligible for credit insurance.
Okay.
Okay? So in this particular scenario, we will still pay the supplier as we normally would. The goods will be delivered to the client. The client will ultimately do whatever they're going to do to it, and then deliver to the customer and invoice them. When we go through our underwriting, and once we've approved them for credit insurance, and that credit insurance is typically equal to what we're paying the supplier, it's to safeguard us, and I'll come back to that in a moment. What happens is that after we pay the supplier, and the credit insurance is issued, we will, Liquid Capital, will invoice our client for what we paid the supplier, our fees, cost of the credit insurance, and then we invoice the client just like any other vendor.
Okay.
And we wait till they get paid by their customer, and when they receive their funds from the customer, although they can pay early if they want, they pay our invoice. So we sit there as a secured creditor, backed up by credit insurance on our client. And the credit insurance is there for two reasons. In case our client was to go bankrupt or pay out of terms. Then we have insurance to be able to reimburse us on our invoice. We don't want that to happen, but that's our safeguard.
Right.
But if we have a client that can meet that underwriting criteria and be credit insurable, we can do a work in process transaction, which can be, again, raw goods for resale, components, manufacturing, packaging, all that. It's a very unique program. It's the only one we're familiar with anywhere in the country. We've been very, very successful with this because it's been a huge void in the marketplace. Another program that we introduced maybe 3 or 4 months ago is an asset-based lending product. Now, asset-based lending, just for a moment to contrast that to a traditional commercial loan. Again, a traditional commercial loan is going to look at your collateral in the sense of receivables, real estate, equipment, inventory, and they will put that into a collateral base overlaid by a cash flow analysis to see what you might be eligible for. In many instances, companies may not be eligible for traditional financing because although they have the assets, the financial ratios don't tie out to the traditional underwriting of that bank. Asset-based lending, as the name would imply, really relies heavily just on the value of the assets and not really a cash flow model. So we're really looking very, very seriously and almost entirely at the value of those assets to be able to come up with a level of financing that we can provide them. So it's typically something where, let's say somebody needs something more than factoring, but they're not eligible for a commercial loan. Asset-based is somewhere in the middle as a stepping stone, ultimately, to commercial lending. The marketplace that we're approaching with this product is one that's been very, very underserved for a lot of years. Typically where we're doing an accommodation or availability of somewhere between $1 and $5 million. Asset-based lending is not new as an industry, and there are a lot of companies that offer it. There are some banks that offer it. But generally speaking, their threshold, lower threshold, is $5 to $7 million and up. There is a huge void in the industry for that that lower market, if you will, that smaller transaction. In fact, I got an email from a business consultant today up in Milwaukee where they have a client that needs roughly a $4 million accommodation. It's smaller than some of their other asset-based lending sources. They know we have this particular product. So we see this as kind of a stepping stone. And in generally speaking, asset-based lending, if everything goes well, is the stepping stone to commercial lending. So it's more than factoring, and it's that intermediary step before commercial lending. So this is a huge market that we're approaching with that particular program. And lastly, we have a program now for unsecured working capital lines, if you will.
Okay.
That would be up to $300,000. It's unsecured.
How much? I'm sorry.
Up to $300,000. It's unsecured. It's typically a shorter term in nature, where the repayment period would be somewhere between low to high 6 to 15 months.
Mm-hmm.
So it's basically where there is a specific working capital need. It's a shorter term need, but they need kind of a bridge. And this is unsecured, so we wouldn't disrupt any of the collateral or security of a bank, if you will.
Mm-hmm.
And a lot of companies run into these short-term needs where they just need some help for a shorter period of time.
Mm-hmm.
They're capable of paying it back within that period. So that's something we offer as well, because I get a lot of calls for, I need $50,000, I need $100,000, I need to buy some more inventory, I need to seize this opportunity.
Right.
I could probably pay it back in, let's say, 12 months or less. So that's a program that we offer as well. So that's kind of the 4 or 5 areas that we work with on a day-to-day basis with our clients.
That's pretty cool. That's interesting. It's, alternative financing is important, especially for, those small businesses that you're helping, because it does seem like banks cater to the companies that don't really seem to need the money as much as, smaller business to be able to get over that threshold and get to that next step. So,
well, banks are in kind of an interesting and very challenging situation right now. It's because clearly after the quote-unquote recession, through various types of legislation, Dodd-Frank and the like, they're under a lot of constraints right now from a regulatory point of view.
yeah.
They're being forced to set aside more capital for loan loss reserves. They're very, very concerned about the regulators coming in and finding any problems with their portfolio.
Yeah.
So they have been rightfully very cautious about some of their underwriting. And the compounding problem they have is that any money that's sitting idle at the Fed earns nothing,
Right.
or little or nothing.
Right.
So they can't put the money out as effectively and as deployed as much as they would like because of the underwriting criteria and restraints.
Mm-hmm.
Not that they don't want to help these clients, but they're dealing with a regulatory environment that makes them very, very cautious unless they want to do something where they're going to put themselves in harm's way.
Right.
So they're really kind of in a very tricky area, which then comes back to a situation where it starts impacting their relationships with their current clients, especially when they say, I can't do any more for you based on the numbers.
Right.
And the problem that they have right now is it costs a lot of money to attract a customer, especially in a fairly competitive environment. So I think they're even more inclined now to do whatever they can to retain that customer as long as there's a good relationship, because if the customer leaves because the bank is not trying to accommodate them, they have to go out and secure a replacement customer.
Right.
So they're in a very, very tricky area right now. And I know I talk to a lot of commercial lenders, which refer a lot of business to me, and it's really kind of a catch-22 for them.
Yeah.
And I don't see that changing dramatically anytime in the near term. The regulatory efforts have only become more stringent. But by the same token, they know there's a lot of folks, there's a lot of liquidity right now. There's a lot of money that could be deployed through the banks, but it's being kind of parceled out, and especially for the kind of clients that I'm working with, maybe startups up to about 30 million in revenue,
Mm-hmm.
and a lot of that in below 30 million, of course. That's a big market that is still a very, very tricky market.
Mm-hmm.
If you're a mid-market company showing any kind of profits these days, you'll have banks fighting to get your business.
Yeah.
All with pricing so razor thin that the sale is really not built on pricing. It's built on relationships and what can you offer to me beyond just the financing.
Right.
But for the other companies that have a little bit of hiccup on their financials, or they're newer companies, it's still a pretty challenging market for them. Yeah. There's a situation where the client or prospective client just needs to know what their options are.
Mm-hmm.
It doesn't have to be something where they're faced with a crisis.
You're right.
I do get things that kind of get thrown in my lap in the 11th hour.
Yeah.
But I like to be proactive, and if it means that we can give them a frame of reference, whether they use that or not, at least they know what their options are.
That's helpful.
And I'm happy to do that. There's no obligation on the part of the client whatsoever. If they just want to just talk about what their situation is and say, here's where you can segue if certain things occur. And I think that gives them a lot of peace of mind where they're not starting from square one when they run into a severe situation. So I think that is just a standing offer. Clearly, if there's anything where you have any client events where it makes any sense for me to have some input to that discussion,
Sure.
I'm happy to do that as well.
Okay.
Because a lot of what I do with these initial conversations is really out of Q&A.
Yeah.
How does this work? What does it mean to me? How long does it take?
Right.
What does the underwriting process look like? That type of thing. So we try to make sure the client's well informed of what the whole overall scenario looks like. We know what the ultimate result is, what they want.
Right.
But there's a lot of questions that come along the way.
Sure.
And so we want to make sure that we can answer those and, give them some level of comfort that, again, if I get this opportunity or if this kind of situation happens, I know who I can call or at least get a frame of reference. And for a lot of them, again, it's what you're doing right now. You're giving them a frame of reference.
Sure.
You're giving them some thoughts to be able to prepare them
Mm-hmm.
and guide them through that process. Again, I find that to be enjoyable when we can do a little proactive planning.
Sounds good.
We can deal with the emergencies, but doing it in a forward-thinking type of situation typically is a great benefit to the client.
Sure. Good. Sounds like you're providing an excellent service that's well needed. Well, I really appreciate you coming and being a part of our little podcast here,
Sure.
and look forward to continuing our relationship.
Good. My pleasure.
Thanks for listening to the Matching Ideas with Resources podcast, sponsored by GLM Financial. I'm Tom Ghosh, business strategist with GLM, steering direction, matching ideas with resources.